Imagine borrowing just less than 10 US dollars to buy food. A few weeks later, you fail to pay back. Your phone starts ringing again and again. Then your contacts start to receive messages saying that you are a loan defaulter. A small loan has become a public humiliation. This is the story of many people across Africa today utilizing digital financial services. A few taps on your mobile phone can unlock emergency cash within seconds. No lengthy application forms, no collateral requirements, no queues at the bank. Mobile loans have become one of the fastest growing financial services in Africa. But that is a question that remains unanswered. Are mobile loans solving poverty, or rather creating a new kind of debt crisis in the region? Mobile lending would never have existed in Africa without mobile money. When M-Pesa was first launched in Kenya in 2007, millions of people suddenly had access to digital payments. Soon, mobile telecom companies realized that they could offer something more valuable than just mobile money transfers: instant credit. Through their mobile networks, companies in Africa began to extend credit to their customers. What started as data and airtime credits later turned into financial credits. Fuliza, a Safaricom overdraft in Kenya, hit total disbursements of 1.47 trillion shillings in 2025. Uganda has more than 2,000 licensed money lenders operating across physical and digital platforms. According to the CEO East Africa magazine, mobile lending apps processed over 156.5 million loan applications in the year 2024 to 2025. So why have millions of East Africans embraced mobile loans? Digital loans are lifesavers to many, mostly used for daily survival needs rather than entrepreneurial or long-term investments. Imagine it's the last week of the month. The food has run out. Rent is due the next day. Your child has been sent home from school, or someone suddenly falls sick. Mobile loans always come in handy. It sounds almost perfect. Instant cash, no paperwork, no collateral required. These loans have enabled the growth and sustainability of a number of informal sector businesses by providing easy and quick access to short-term capital. So where does everything go wrong? What starts as one emergency loan often becomes two and then three. Borrowers start taking one loan simply to pay another, and before long, escaping the debt cycle becomes almost impossible. Most digital loans are characterized by high interest rates and unclear terms and conditions. Repayment periods are too short, usually ranging between 14 to 30 days. Many people do not fully understand how interest accumulates and how penalties are triggered. Their unregulated persuasive ads often lure vulnerable borrowers into taking more loans. Many people are harassed and shamed by lenders due to failure to pay their loans on time. Borrowers unknowingly grant lenders permissions to access and use contacts, photos, and other private information on their devices. But is it legal for lenders to contact people that were not listed as guarantors because the initial borrower has failed to pay their loan debts? The pressure isn't only financial. For some borrowers, the stress becomes too overwhelming, and in some cases, debt disputes have become violent. In 2023, Ivan Wawire, a Ugandan police constable, shot and killed Utan Bandari, a Tier 4 microfinance money lending officer in Kampala over a 2.1 million shillings debt. However, it is important to note that there are laws governing digital lending. In Uganda, Kenya, and Tanzania, digital money lenders are regulated by financial authorities alongside data protection and consumer protection laws. The laws require lenders to be licensed and restrict how they collect debts and handle customer information. Although a number of companies have been flagged as illegal operators in East Africa, many are still operating and can be accessed through download on major app stores. Others continue attracting customers through online advertising and pop-up promotions. But if regulators have already identified these illegal operators, why are they still accessible amongst smartphone users? Mobile loans are not the problem. For millions of Africans, loans are often the only source of emergency cash. The real challenge is ensuring that technology designed to increase financial inclusion does not become a tool for exploitation. Because when borrowing becomes a way of surviving, Debt stops being a financial problem. It becomes a social problem and sometimes a psychological one.